Today we've got some major news coming straight from Berkshire Hathaway. Their CEO, Abel, just spoke about resuming the company's long-standing share buyback program, and he also shared insights in his first shareholder letter after officially taking over from Warren Buffett. In a moment, I'm going to show you the key video clips where Abel explains the reasoning behind restarting buybacks, the factors they consider when determining value, and how Berkshire is approaching capital allocation under new leadership. After watching these clips, I'll break everything down for you with an in-depth analysis, including what this could mean for shareholders, how it fits into Berkshire's broader strategy, and my personal take on the decisions Abel is making. If you get value from this video, make sure to like, share your thoughts in the comments, and subscribe to the channel so you don't miss out on the next important analysis update. Now, let's watch the video.
We have some breaking news right now coming from Berkshire Hathaway. The company has just filed a Form 4 and an 8K. And joining us to talk about those topics and his first letter to shareholders after taking the reins from Warren Buffett is Berkshire Hathaway CEO, Abel. Greg, welcome. It is great to see you this morning.
It's great to be here. Good morning, Becky. Morning, Joe.
Thank you for being here.
We really appreciate your coming on set. We have so much to talk about. But let's jump in with the news that is just crossing the wires, and that's what's coming from the 8K. That's the big headline here, that Berkshire Hathaway has begun repurchasing shares of the common stock under the previous policy that had been out there before. How many shares are you buying back? Why are we hearing about this?
Yes, so we've had a long-standing policy that when the intrinsic value, as we see it, and computed on a conservative basis, when it exceeds our market price, Berkshire has always acquired shares. That's been our long-standing policy. We highlighted that in the 10K and in my letter that remained in place, and we've just recommenced yesterday. So the point being, we see value, the intrinsic value exceeds the current market value, and we started recommence purchasing. And we felt it was important to communicate to our shareholders, our partners, our owners, that with the transition of leadership, and that this is the first time we're purchasing shares, it was important to let them know we've recommenced.
Yeah, the last time that you had bought back shares was May of 2024. Berkshire shareholders have long realized that it might be Charlie, maybe, or Warren talking to each other, kind of figuring what they thought was a fair value for the price of things. Did you talk to anybody about it, or you looked at it and you thought this is a good time to be buying back?
No, absolutely talked to Warren. So how I approached it was obviously looking at the value, having a view of intrinsic value, consulted with Warren relative to the value and the timing of, are we ready to recommence? And the thought there was, after the consultation, we filed our 10K. There's a 48-hour cooling off period, Monday and Tuesday, and we commenced purchasing on Wednesday morning.
Have you been looking at this for a long time?
We look at it continuously.
What are the three top things that would make you think that is something to price to sales? Is it what jumps out as a signal that the intrinsic value is not recognized by the share price? Which thing?
What we always look at is what are the economic prospects of each of our companies in Berkshire. Mm-hmm. And we look at that over the long term.
Is it a gut feeling more than, are there numbers where you'd say, okay, this hit 80% of book, this part of Berkshire, or something like that? Nothing that specific.
It's really just looking at the economic opportunities that exist within Berkshire, and are we comfortable that the value proposition is very strong, and we're doing it on behalf of, obviously, our shareholders and owners. We have to view this as value, that we're creating value for our shareholders long term.
So if the stock goes up from the announcement or from the buybacks, how long would you do this? How much will you keep doing it until it remains the case that you feel it's undervalued? You can do as much as you want?
Correct. As long as our intrinsic value exceeds the market value, again, conservatively determined, we'll continue to repurchase. But the one thing we have never done is we don't disclose the amount, the timing, or the computation. But we did feel this time it was important because of the change in leadership that we should
not even
highlight.
A ballpark.
So we're not going to hear something like this from you again. We won't know when you're in the market buying back.
This is a one-time event to let our shareholders know.
And you won't say it's a $20 billion buyback and we're halfway through. We won't know anything.
Correct.
Is that a reasonable number? Could it be? It could be a lot more at Berkshire.
It's completely dependent upon the intrinsic value.
Okay.
And how that equation remains in place.
So Berkshire shares up until a minute ago were down maybe 1% over the last year. Market's been up. You guys have $373 billion in cash as of the last filing.
Correct.
I guess you're looking around and it tells you that this is something that makes way more sense to you than buying other things, other stocks, but making other purchases.
Exactly. We always look at effectively three buckets when we're allocating our capital. We have our existing businesses, deploying capital back into those, both for their current operations and incremental opportunities. That really exists every day, and we're constantly challenging ourselves. Are we thinking about that properly? As you highlighted, Becky, there's also, do we acquire stock? And when we're looking at companies, do we acquire whole companies also? And then there's do we acquire equities, other equities? And as we've highlighted, we always look at that as very similarly to buying 100% or 2%. And then the third bucket where we deploy our capital is share repurchases. Each of those, with the amount of capital they have, can be done independently. So when we're purchasing our shares, it's not taking away from any of the other decisions.
Now, the first thing to understand is why Berkshire would resume buybacks at this moment. Greg Abel made it very clear that they are following the same long-standing policy set during Warren Buffett's era. Berkshire only repurchases its stock when its intrinsic value, as conservatively calculated, exceeds the current market price. This is classic Buffett logic. Essentially, they're saying, we see that our stock is undervalued, and we believe this is a smart way to create shareholder value. And that's huge. Because this isn't just a casual decision. A company like Berkshire, sitting on nearly $373 billion in cash, could technically do a lot with that money. They could acquire other companies, they could invest in growth initiatives across their vast portfolio, or they could just let the cash sit. Instead, they've chosen buybacks as the most effective use of capital at this moment. That sends a very strong signal to the market that management believes Berkshire shares are currently undervalued. Now, one of the questions people often ask when buybacks are announced is, how much are they buying? Are we going to see billions of dollars flowing into the stock? And here, Greg Abel was clear but also cautious. He confirmed that the buybacks have recommenced, but he stressed that they do not typically disclose the amount, timing, or computation behind the buybacks. This means shareholders won't see ongoing updates about the purchases. In other words, it's a very deliberate and measured move. They want to make it clear they are creating value without over-communicating or giving away strategic information to the market. Interestingly, though, this announcement is being treated as a one-time disclosure because of the leadership transition. Abel wanted shareholders to understand that even under new management, Berkshire remains committed to the same principles that Buffett and Charlie Munger instilled over decades, and that continuity is critical. For long-term investors, it's reassuring because it signals that while the leadership may have changed, the disciplined, value-focused approach to capital allocation hasn't. Now, let's talk about something that really stood out to me. When asked whether he consulted Warren Buffett before restarting buybacks, Abel was very straightforward. He absolutely did. He confirmed that they spoke about both the intrinsic value of the stock and the timing of the buyback. That's crucial because it shows that even though Greg Abel is now at the helm, he's not making these decisions in isolation. There's still a level of mentorship and continuity in the thought process, and from my perspective, that's a smart move because it ensures that Berkshire isn't deviating from the disciplined investment philosophy that has made it the powerhouse it is today. Another key point Abel touched on is the way Berkshire assesses intrinsic value. He emphasized that it's not just a gut feeling. They continuously evaluate the economic prospects of each company within the Berkshire portfolio. This is really important because Berkshire isn't a single business. It's a massive conglomerate with stakes in everything from insurance to energy to retail. Each subsidiary has its own growth opportunities and risk profile. By assessing the economic prospects of these companies and how they contribute to the overall intrinsic value, Berkshire can make a more informed decision about whether the market is underpricing the stock. And here's my take on that. What we're seeing is the hallmark of disciplined capital allocation. Most companies in the market will look at a stock being cheap based on simple metrics, maybe a price-to-earnings ratio or some other quick valuation method. Berkshire, however, is looking at the long-term earnings potential of all of its businesses, adjusting for risk, and comparing that to the current market price. That's a much more sophisticated approach, and it's part of why their buybacks have historically been value-enhancing. Now, the timing of this buyback is interesting too. Abel mentions a cooling off period after filing the 10K, and they started purchases on the following Wednesday. This shows a very methodical, rule-driven approach. They're not reacting to market noise or short-term fluctuations. They're acting based on their internal calculations of value. And that's exactly the kind of discipline that long-term investors should be encouraged by. Abel also made it clear that Berkshire is looking at three primary buckets when allocating capital: reinvesting in existing businesses, acquiring new companies outright, or purchasing shares, either their own or other equities. The decision to restart buybacks indicates that, for now, repurchasing their own stock offers the highest value proposition compared to alternative uses of capital. That's a really strong statement about how undervalued they believe the shares are relative to other opportunities. I also want to touch on something subtle but important that Abel said. He stressed that buybacks will continue as long as intrinsic value exceeds market value, but they will never provide specifics about the amount or timing. To me, this reinforces two things. First, the emphasis is always on value, not volume. Second, they're not trying to manipulate the market with announcements or targets. It's about disciplined capital deployment, pure and simple. And honestly, that's one of the reasons Berkshire has been able to compound value over decades, because the focus is on real economic value rather than short-term market optics. Before moving on, I also want to point out the psychological effect this announcement can have on the market. Even without disclosing exact figures, simply stating that buybacks have resumed sends a powerful signal to investors that management believes shares are undervalued. That can spark renewed confidence among existing shareholders and potentially attract new investors who trust the judgment of Berkshire's leadership team. Now, here's a question I often get from viewers. How does this fit into the broader market context? Shares have been down about 1% over the past year while the market has risen. Well, think about it. If the market has been climbing but Berkshire's stock hasn't kept pace, it could very well indicate that the stock is undervalued relative to its intrinsic value. And that's exactly what Greg Abel is acting on. He's not reacting to market sentiment, he's reacting to the fundamental value of the company's assets and operations. One of the things that really stands out to me in this interview with Greg Abel is how methodical Berkshire is about capital allocation. Abel mentioned three buckets when deciding how to deploy capital: reinvesting in existing businesses, acquiring new companies outright, and purchasing shares, either their own or other equities. This framework is classic Berkshire Hathaway. It's not about throwing money at whatever looks hot in the market or chasing quarterly returns. Instead, every dollar is carefully evaluated for the long-term value it can create. That's a mindset that has kept Berkshire at the top of the investment world for decades. Now, when it comes to reinvesting in existing businesses, think about Berkshire's insurance operations, their energy companies, and their manufacturing holdings. These are businesses that generate enormous cash flow year after year. By redeploying capital here, they're fueling growth internally, supporting expansions, upgrading infrastructure, or taking advantage of incremental business opportunities. In other words, they're ensuring that their core engines continue to run efficiently and profitably. Then there's the bucket for acquiring whole companies, which has always been a key part of Berkshire's strategy. We've seen this over decades, from GECO to BNSF Railway to Lubrizol. Berkshire tends to buy companies that have durable competitive advantages and excellent management teams. Abel didn't go into specifics in this interview, but the message is clear. Buybacks aren't a replacement for acquisitions. They're one of multiple tools to deploy capital efficiently. And that brings us to the third bucket: share repurchases. This is where it gets interesting. Abel explained that share buybacks will continue as long as intrinsic value exceeds market price, but he also emphasized that Berkshire will never give details about timing or amounts. That's classic Buffett-style discretion. And from my perspective, it makes sense. If they disclosed every purchase, the market could try to anticipate their moves, which could actually drive the stock price away from fair value. By keeping it private, Berkshire is staying disciplined and focused on long-term value creation, not short-term market reactions. Now, let's talk about the $373 billion cash position. That's an enormous pile of cash, even by Berkshire standards. With such liquidity, the company has options most others don't. Abel highlighted that the buyback decision was made in part because deploying this cash to purchase shares is currently more attractive than other opportunities. That's a very telling point. Think about it. If you're sitting on almost $400 billion in cash, there's a huge opportunity cost to letting it sit idle. You could invest in new businesses, make strategic acquisitions, or even buy other public equities. But here, The leadership team determined that repurchasing Berkshire stock itself is the most efficient way to generate value right now, and that is a clear signal to shareholders that they believe their own stock is undervalued relative to the intrinsic value of the underlying businesses. Some analysts have speculated about the $20 billion figure that has been floated in the media, but Greg Abel was very cautious here. He didn't confirm any number, and he reinforced that it's entirely dependent on intrinsic value calculations. That's key. Berkshire isn't committing to a fixed buyback program like some companies that announce up to $20 billion over the next year. Instead, they're acting dynamically. If intrinsic value continues to exceed market price, they could repurchase significantly more, or less. From a personal perspective, this is one of the reasons I find Berkshire so fascinating as a company. They're playing the long game and they're willing to be patient. Unlike many corporations that feel pressure to constantly announce buybacks or dividends to appease short-term investors, Berkshire is focused on maximizing intrinsic value over decades, not quarters. And as an investor myself, that level of discipline is reassuring. Another element worth highlighting is the consultation with Warren Buffett. Even though Greg Abel is now CEO, he made it clear that he spoke with Buffett before resuming buybacks. That's more than just a procedural step. It's a continuation of a value-driven philosophy that has guided Berkshire for decades. For long-term investors, that continuity is extremely valuable. You don't want sudden shifts in strategy when leadership changes. This tells the market and shareholders that the principles that made Berkshire successful are still very much in play. Now, let's consider the broader implications for shareholders. First, restarting buybacks can have an immediate effect on the stock. By repurchasing shares, Berkshire reduces the total number of shares outstanding, which can boost earnings per share and create long-term value for shareholders who remain invested. It's a direct way to increase value without changing the fundamentals of the business. Second, it's a confidence signal. When management is willing to deploy billions of dollars of cash to buy their own shares, it shows that they truly believe the stock is undervalued. That can be psychologically powerful for the market. It often encourages long-term investors to hold, and even attracts new investors who trust the judgment of Berkshire's leadership. Another interesting point Abel made was about how they determine undervaluation. He noted that it's not based on a single metric but on continuous evaluation of economic opportunities within Berkshire's businesses. This is really sophisticated. For example, if one of their subsidiaries is in an industry with strong long-term growth prospects, that increases the intrinsic value of the parent company. Conversely, if another business faces challenges, that gets factored in as well. The result is a comprehensive, nuanced view of what the stock is actually worth. And here's my personal take. This approach also protects Berkshire from making poor buyback decisions during market hype or panic. Unlike companies that announce buybacks during a short-term dip or to prop up stock price, Berkshire is evaluating true underlying value. That's why these buybacks are likely to be much more meaningful in creating long-term shareholder wealth. Finally, it's worth noting the timing relative to market performance. Abel pointed out that Berkshire shares had been down roughly 1% over the past year while the broader market rose. This divergence could indicate that the market isn't fully appreciating the intrinsic value of the company's assets. That gives management the opportunity to deploy capital effectively. Buybacks at prices below intrinsic value are essentially risk-free value creation for shareholders. From a strategic standpoint, that's textbook Buffett thinking applied under Abel's leadership. Alright, so now that we've gone deep into the buybacks and capital allocation strategy, let's step back and look at what this all means for the long-term growth trajectory of Berkshire Hathaway. One of the things that struck me while watching Greg Abel's interview is how deliberate and disciplined Berkshire remains, even under new leadership. While Abel is now the CEO, he is clearly building on the principles that Warren Buffett and Charlie Munger instilled over decades: long-term thinking, intrinsic value focus, and capital allocation discipline. This approach has several implications. First, it tells investors that Berkshire is unlikely to make impulsive or speculative moves with its cash. There's no pressure to chase market fads or hype. Instead, capital will be deployed in a way that maximizes long-term value, whether that's reinvesting in existing businesses, buying entire companies, purchasing equities, or repurchasing their own shares when undervalued. For shareholders, that's reassuring. In a market full of volatility and uncertainty, knowing that the company is making decisions rooted in fundamental value is a massive advantage. Now, let's talk a little bit about the buyback impact on shareholders. When a company repurchases shares, the total number of shares outstanding decreases. This can directly increase earnings per share and enhance intrinsic value per share, even if the underlying business doesn't change at all. And when you consider the scale at which Berkshire operates, billions in cash and dozens of high-quality subsidiaries, the compounding effect over the long term could be significant. Essentially, every dollar spent on buybacks below intrinsic value is a dollar directly adding to shareholder wealth. From my perspective, that's where the genius of Berkshire's strategy lies. They're not just repurchasing shares to boost short-term stock price, they're doing it in a way that enhances real economic value over time. That's a critical distinction. Many companies engage in buybacks just to satisfy Wall Street expectations, sometimes even at inflated stock prices, which can actually destroy shareholder value. Berkshire, on the other hand, is focused on true long-term wealth creation, and that's why these decisions matter so much to long-term investors. Next, I want to dive into Abel's leadership style. One thing that becomes evident in this interview is how methodical, cautious, and consultative he is. Even though he's now the CEO, he spoke directly with Warren Buffett before resuming buybacks. That shows respect for continuity and the proven decision-making framework that has guided Berkshire for decades. But at the same time, Abel is clearly confident in his own judgment. He's evaluating intrinsic value continuously, looking at the economic prospects of each subsidiary, and deciding when it makes sense to deploy capital. To me, that balance between respect for tradition and independent decision-making is exactly what investors want to see in a new CEO. It shows that Berkshire's leadership transition is smooth, thoughtful, and unlikely to disrupt the company's long-term trajectory. And for those of us analyzing value stocks, it's a reminder of how critical leadership continuity and philosophy alignment are when assessing an investment. Now, let's bring this back to value investing principles, because this is really what makes this interview so interesting from an investor's perspective. Greg Abel mentioned repeatedly that buybacks will only occur when intrinsic value exceeds market price. That's textbook value investing. Buy low, hold high, and focus on the underlying economics rather than market sentiment. For someone like me analyzing Berkshire, it reinforces that the company is following the principles that made it a model for investors worldwide. This approach also offers a broader lesson for investors today. In a world where many stocks are priced based on hype, speculation, or short-term momentum, Berkshire is acting as a reminder that true value creation comes from assessing fundamentals, understanding the long-term economic potential of your investments, and deploying capital wisely. That's why I personally look at Berkshire not just as a stock, but as a case study in disciplined investing and strategic capital allocation. Another point I found fascinating was how Abel discussed the $373 billion cash position and the decision to allocate some of that toward buybacks. Think about it. Most companies would be under pressure to spend that cash quickly, maybe even make questionable acquisitions or risky investments, but Abel and his team are taking a measured approach, evaluating all options and deploying capital where it creates the most value. That's a rare mindset in corporate America, and it's one of the reasons Berkshire has such a track record of long-term success. Now, let's consider the market reaction. Shares had been down roughly 1% over the last year, even while the broader market has risen. On the surface, that might look like underperformance, but when you dig deeper, it signals something more profound. Berkshire shares may be undervalued relative to their intrinsic worth, and that's exactly why management chose to resume buybacks. In essence, this move is saying to the market, we believe in the underlying value of this company more than the current market does, and we're willing to put our money where our mouth is. And here's my personal take on that. When management is willing to deploy billions of dollars to repurchase shares at what they believe is a discount, that's about as strong a vote of confidence as you can get. It's the type of move that long-term investors should pay attention to because it signals both discipline and conviction. Finally, let's wrap this all up with some key takeaways. First, Berkshire Hathaway is resuming buybacks because management believes the stock is undervalued relative to intrinsic value. Second, this decision fits within a broader capital allocation framework that includes reinvesting in existing businesses, acquiring new companies, and purchasing other equities. Third, Abel's approach reflects both continuity and independent judgment, maintaining the Buffett-Munger philosophy while actively evaluating opportunities. Fourth, the $373 billion cash position gives Berkshire the flexibility to deploy capital strategically, and buybacks are simply the most attractive option at this time. And fifth, for long-term investors, this is a signal of both value creation and confidence in the company's future. So here's my final opinion. I believe Greg Abel is off to a very strong start as CEO. He's maintaining the disciplined, value-driven approach that has made Berkshire legendary, while also demonstrating the ability to make independent decisions when appropriate. For anyone invested in Berkshire or considering investing, the message is clear. This is a company still committed to long-term wealth creation, and the current buybacks reflect that commitment in a very tangible way. And with that, we've fully broken down Greg Abel's announcement, his perspective on buybacks, and the broader implications for shareholders and value investors. This isn't just a news update, it's a blueprint for understanding how disciplined capital allocation and value investing principles are being applied under new leadership at one of the most iconic companies in the world. If you enjoyed the video, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.